Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone.
We've got a lot to cover today.
Absolutely. We've got a packed hour ahead as we delve into the crucial financial news of the day, drawing insights from a range of top-tier publications.
Exactly. Today's deep dive pulls from the latest reports in Bloomberg and MarketWatch, offering a comprehensive look at everything from global political shifts to the nitty-gritty of market reactions and corporate strategies.
And our goal, as always, is to connect the dots for you, making sense of these headlines and their potential impact on your financial world without burying you in jargon.
Let's jump right in.
Okay, let's unpack this, starting with a headline out of MarketWatch that immediately caught my eye.
Yeah.
The uncertainty now hanging over Germany's chancellorship.
Ah, yes, Friedrich Merz.
His initial bid to become Germany's chancellor surprisingly failed in the first parliamentary vote, falling just 6 votes short.
Just 6 votes? It's fascinating, and what MarketWatch really highlights is the delicate political landscape in Europe's largest economy.
He needed 316. Right.
Needed 316 votes in the Bundestag, that's the German parliament, but only secured 310 in the secret ballot.
So what happens now?
Now, the Bundestag has a 14-day window to elect a chancellor with an absolute majority.
So Merz can try again.
He can certainly try again, yes. But this period of uncertainty also opens the door for other potential candidates to emerge.
And here's where it gets really interesting when you consider the broader context. This leadership vacuum in Germany isn't happening in isolation.
No, not at all.
As MarketWatch points out, it coincides with a whole host of significant global challenges.
Like the war in Ukraine.
The war in Ukraine, the unpredictable nature of U.S. trade policy under a potential returning Trump administration.
A stagnant domestic economy in Germany itself.
And the growing influence of a far-right political party there, too. It feels like a perfect storm of uncertainty.
It really does. And if we connect this to the bigger picture, any prolonged political instability in Germany, a key anchor of the European Union,
It's bound to raise concerns.
can't help but raise concerns about broader European economic and political stability.
How did the markets react initially?
Well, the initial market reaction, as reported by MarketWatch, saw the German DAX, Germany's main stock index, dip further into negative territory after the vote.
But the euro?
The euro's reaction was more muted, surprisingly.
So more of a domestic equity concern for now.
Seems like it. Suggests an immediate concern primarily within the German equity market about the lack of clear leadership. It makes you wonder what kind of policy decisions might be delayed or altered during this period.
Definitely something to watch.
Mm.
Okay, moving on to another major theme dominating the financial news. Let's talk about the tangible impacts of tariffs.
Always a big topic.
MarketWatch has a compelling piece detailing how Ford, they're now projecting a significant $1.5 billion hit to its profits in 2025, specifically due to Trump's tariffs.
$1.5 billion? That's a huge number.
And they've even taken the step of halting their full-year profit guidance.
Right, citing substantial risks, which notably include the potential for both increased U.S. tariffs and retaliatory tariffs from other nations.
That guidance halt is significant.
It is a substantial figure, and as the MarketWatch article emphasizes, it directly quantifies the financial pain that these trade policies can inflict on major multinational corporations.
And they mentioned mitigation efforts.
What's also insightful is the detail that this $1.5 billion impact would have been even more severe had Ford not implemented certain mitigation strategies.
Like what?
Like utilizing bonded carriers for shipments between Canada and Mexico, a process that allows goods to move between countries without immediate tariff payment.
Okay, so they softened the blow somewhat.
Somewhat, but when you consider that Ford's first quarter adjusted profit was $1 billion, well, that annualizes to a figure significantly below their previous, more optimistic forecasts.
So the added pressure from tariffs is really apparent.
It highlights how quickly these trade headwinds can erode profitability.
And it's not just the automotive giants feeling the squeeze, is it?
No, definitely not.
MarketWatch also reports that the toy maker Mattel is planning to raise prices on some of their toys in the U.S.,
explicitly citing anticipated increases in tariff costs starting in the third quarter. So this isn't just a boardroom issue.
It's something that could directly affect consumers' wallets. Absolutely.
Exactly. Mattel's situation, as outlined in the MarketWatch piece, provides a clear example of how tariffs on imported goods can translate into higher prices for everyday consumers.
The CEO had something to say too, didn't they?
Yes, the CEO's statement, also highlighted in the article, advocating for zero tariffs on toys.
emphasizing their importance for child development.
Adds an interesting ethical dimension to this economic discussion, doesn't it?
It does, and they're also changing their manufacturing strategy.
Simultaneously, Mattel is taking proactive steps to reduce its reliance on Chinese manufacturing,
What's the target?
aiming to bring U.S. imports from China down to below 15% by next year and under 10% by 2027.
Wow, that's a significant shift.
It underscores a long-term response to the uncertainties and potential costs associated with the current tariff landscape.
And they pause guidance too, like Ford.
They, too, have paused their full-year 2025 guidance, echoing Ford's concerns about the volatile macroeconomic environment and evolving U.S. tariff landscape.
Okay, let's zoom out and look at the other side of the trade equation, China.
Right. Bloomberg has a report indicating a more significant than expected slowdown in China's services sector in April.
The KKIM Services PMI.
Yes, the Caixin China Services Purchasing Managers Index fell to a 7-month low of 50.7. Remember, above 50 is expansion, below is contraction.
Still expansion, but barely. And U.S. tariffs are partly blamed.
Partly attributed to the impact of U.S. tariffs, yes. So it seems these policies are having a reciprocal effect.
That's a critical point. This Bloomberg report underscores that tariffs aren't a one-way street.
Not at all. While the U.S. imposes them, the Chinese economy is also feeling the repercussions.
And this follows factory weakness too.
The fact that this slowdown in the services sector follows a reported hit to Chinese factory activity due to earlier U.S. tariff hikes raises concerns about a broader, maybe more rapid deceleration of economic growth in China during the second quarter.
So the big question is stimulus.
The big question, as Bloomberg highlights, is whether Chinese policymakers will be able to effectively stimulate domestic consumption to offset the anticipated decline in export demand resulting from these tariffs.
How's the outlook looking within China?
Not great. The drop in expectations for future activity within the services sector fell to its second lowest level since 2005. That's particularly noteworthy.
Suggests weakening sentiment among businesses there.
Definitely. And services firms reduced staff again in April for the second month running, citing cost concerns.
Analysts are forecasting lower GDP growth for China this year too, right?
Yes, forecasts are pointing towards deceleration, maybe around 4.2%, which is below their official target of about 5%.
Interestingly, MarketWatch also features analysis suggesting the U.S. stock market might have already factored some of this in.
From Seven's report research, yes. They suggest the market might have priced in a potential backtracking on Trump's Liberation Day tariffs.
What does backtracking mean here? Delays, exemptions.
Their thinking is that delays and exemptions, particularly for key sectors like computer chips, electronics, pharmaceuticals, automobiles, are already kind of baked into current market valuations.
So if the market has already priced this in,
This is a crucial insight from Seven's report. If the market has indeed priced in a softening of the tariff stance, it raises questions about the potential for further upside in the recent market rally.
could even be a sell the news situation.
In fact, the report suggests we could even witness a sell the news reaction if and when trade deals are announced, as the actual details might not live up to the market's already optimistic expectations.
But tariffs are still higher overall.
It's vital to remember, as the MarketWatch article points out, that overall tariff levels are still expected to be significantly higher than they were at the beginning of the year.
So still a drag on growth.
This will continue to act as a drag on economic growth, regardless of any perceived backtracking.
Okay, and if these tariffs do start to bite harder and faster than any potential tax relief,
Yeah,
what then? MarketWatch raises a fascinating possibility.
bailouts.
Industry groups representing retail, manufacturing, freight, they're reportedly lobbying the GOP for sector-specific bailouts.
Wow.
These potential bailouts could be attached to the ongoing tax bill negotiations, or even a future government funding bill. It's a stark illustration of the pressures.
This lobbying effort really brings home the practical challenges that businesses are facing on the ground.
What's the administration's line?
The Trump administration's stated position, as reported by MarketWatch, is that the proposed tax cuts will provide sufficient economic support to offset any negative impacts from tariffs.
But economists are skeptical.
Economists cited in the article express skepticism, suggesting that the current tax bill, focused more on individual tax cuts, might not deliver the immediate stimulus needed to counteract the direct costs imposed by tariffs on these specific industries.
The prospect of bailouts raises a whole host of questions, doesn't it?
About long-term economic efficiency, the role of government intervention, absolutely.
Okay, let's shift our focus across the Atlantic. The Bank of England.
Right. Bloomberg's reporting that money markets are now fully anticipating 4 more quarter-point interest rate cuts by the BOE before the end of this year.
4 more cuts. That would bring the rate down to
3.5%. That's a significant expectation of monetary easing.
what's driving that expectation.
It largely reflects growing concerns about a potential slowdown in global economic growth, particularly in light of recent U.S. economic data showing, well, contraction in Q1 alongside persistent inflation.
And a cut is expected soon.
The prevailing consensus among economists and traders, according to Bloomberg, is for the Bank of England to implement a quarter-point rate cut as early as next week.
That would be their second this year.
Second reduction this year, bringing the rate to 4.25%.
And some economists think they should go faster.
Interestingly, yes. Economists at Morgan Stanley are even suggesting that the BOE should act more decisively, advocating for a benchmark rate closer to 3.5% sooner rather than later.
But they expect pushback.
Although they anticipate some resistance to such aggressive easing from within the central bank itself, their own forecast is for the BOE's key rate to fall to 3.25% by year-end.
So even more dovish than the market.
Indicating a more dovish outlook than the current market pricing, yes.
Okay, let's turn our attention to India now. Bloomberg has a report on geofinance,
Mukesh Ambani's shadow lender. They're planning their first onshore bond sale.
aiming to raise up to 10 billion rupees, which is about
Roughly 118 million US dollars. It's their first foray into the local bond market.
What's noteworthy about this?
Well, as Bloomberg points out, this marks their debut issuance of a local currency bond. The bond itself received a high credit rating AAA with a stable outlook from CRISIL Ratings.
So the market's confident.
Speaks to the market's confidence in its creditworthiness, definitely.
And the proceeds are for.
The funds raised are specifically earmarked for onward lending activities, aligning with GeoFinance's broader strategy to capitalize on India's rapidly expanding digital economy.
By offering more financial products.
Exactly. Offering a diverse range of financial products, including seamless integration within the widely used MyGeo consumer application.
So this could signal more expansion for them.
Could signal further expansion and diversification of GeoFinance's funding sources in the future.
Okay, circling back to the global equity markets. Goldman Sachs has some thoughts on the recent rally.
Ah, yes, the bear market rally caution.
Goldman Sachs strategists, as reported by Bloomberg, are cautioning that the recent recovery we've seen bears the hallmarks of a typical bear market rally.
They're emphasizing the ongoing uncertainty, noting that price movements are largely being driven by short-term news flow, particularly headlines concerning U.S. tariffs.
So don't get too carried away.
That's precisely the message Bloomberg conveys from Goldman's analysis. They highlight the historical pattern of sharp but ultimately unsustainable rebounds during broader bear market phases.
What's their core argument? Upside limited.
Their core argument is that while the potential for significant downside might be limited if the tariff situation were to quickly de-escalate without lasting economic damage, while the upside potential for equities is also constrained at current valuation levels.
Creates a tricky environment for investors.
A challenging environment, yes. You face the risk of chasing temporary gains that could quickly fade, or, conversely, missing out on further potential upside if the market's assessment changes.
Are big investors buying in?
It's interesting, the fact that macro-focused investors have reportedly been trimming their equity exposure, despite the recent rally being partly supported by systematic buying,
Suggests underlying caution.
underscores a cautious underlying sentiment. Continued volatility, particularly around upcoming events like the Federal Reserve meeting, is probably to be expected.
We're also seeing some interesting activity in the currency markets. Hong Kong.
Yes, Bloomberg reports that Hong Kong authorities, acting through the Hong Kong Monetary Authority, the HKMA, have significantly ramped up their sales of the local Hong Kong dollar.
Why? To defend the peg?
To defend its long-standing peg to the U.S. dollar as the greenback has experienced some weakening, this is a pretty significant intervention.
How significant?
Indeed. As Bloomberg details, the scale of the HKMA's intervention has been substantial, reaching a record HK $60.5 billion sold on Tuesday alone.
Wow. And that's on top of previous sales.
Adding to the already significant HK $56.1 billion sold since the previous Friday.
That shows real commitment to the peg.
This aggressive action underscores their firm commitment to maintaining the established trading band of 7.75 to 7.85 Hong Kong dollars per U.S. dollar.
And this is happening as other Asian currencies gain.
Exactly. This intervention comes at a time when several Asian currencies have been gaining ground, fueled by hopes of a potential easing of U.S.-China trade tensions and increasing doubts about, well, U.S. economic exceptionalism.
Does this intervention have other effects?
Furthermore, these HKMA sales have the secondary effect of dampening borrowing costs within Hong Kong,
Which had risen because of.
which had risen due to increased demand for the local currency related to a major upcoming IPO contemporary Amperex technology.
So lower borrowing costs could help Hong Kong's economy.
Could provide a welcome buffer for Hong Kong's economy as it navigates the complexities of the ongoing U.S. tariff situation.
In a similar vein, Taiwan's central bank has been active too.
That's right. Bloomberg also reports that Taiwan's central bank has confirmed its purchase of U.S. dollars in April,
Boosting the reserve.
leading to a 0.8% increase in their foreign currency reserves, which now stand at $582.8 billion. Looks like they're also actively managing their currency.
Why were they buying dollars? Taiwan dollar strengthening.
This intervention occurred amidst growing upward pressure on the Taiwan dollar. The $4.8 billion increase in their foreign reserves represents the largest monthly rise since August of last year.
What was driving the Taiwan dollar up?
The Taiwan dollar experienced significant appreciation in April and into early May, partly fueled by speculation that Taiwanese authorities might allow the currency to strengthen as a way to ease trade discussions with the U.S.,
Because the U.S. threatened tariffs on Taiwan.
which has recently threatened tariffs on goods imported from Taiwan, yes.
But the central bank blames speculators.
However, the central bank governor has publicly attributed the currency's appreciation to speculative trading and indicated that the interventions were necessary to maintain orderly market conditions.
Okay, let's turn to a concerning trend here in the U.S. student loans.
Yes. MarketWatch is highlighting alarmingly high rates of student loan delinquency.
How high?
A record 20.5% of student loans that are currently due for payment or at least 90 days past due in February.
20%. And that doesn't even include loans in forbearance or deferment.
That's correct. It's a significant portion of borrowers struggling.
The data, sourced from TransUnion, paints a worrying picture.
This 20.5% delinquency rate surpasses the previous record set back in February 2012, indicating a worsening trend.
And it's hitting borrowers who previously had good credit.
What's particularly concerning is the increasing number of borrowers who had good credit scores classified as prime or even super prime before they fell behind on their student loan payments.
How many?
The article notes that nearly 1/4 of those who are at least 90 days delinquent initially had prime credit scores.
And falling behind really hurts your credit score.
As MarketWatch emphasizes, falling behind on student loans can have severe consequences for borrowers' credit scores, making it much harder and more expensive to access credit later. Prime borrowers see an average drop of 99 points, super prime 175 points.
Ouch. And collections are resuming for defaulted loans.
The impending resumption of collections for defaulted student loans by the Department of Education could add further financial strain on approximately 5 million borrowers.
And there are shadow delinquencies too.
Additionally, yes, the existence of what are termed shadow delinquencies, millions more loans that are significantly past due but not yet formally classified as delinquent, suggests the true scope might be even larger.
Are there system issues contributing?
Technical and logistical hurdles with the loan repayment systems are also cited as contributing factors, making it difficult for some borrowers to stay current even when they are trying to make payments.
Okay, shifting to the tech world. OpenAI. MarketWatch has an interesting development.
Changing their structure, abandoning the for-profit plan.
Apparently abandoning its previously discussed plans to restructure itself as a for-profit business. Instead, the company will remain under the control of its existing nonprofit organization.
With its for-profit arm becoming a public benefit corporation, a PBC, that's a significant shift.
Why the change?
It is a notable change, and as OpenAI CEO Sam Altman explained in the MarketWatch article, this decision comes at a time when the company is struggling to keep up with the immense global demand for its AI services.
Can't supply enough AI.
Altman suggested that meeting this demand and making advanced AI broadly accessible will require staggering amounts of capital, potentially hundreds of billions or even trillions of dollars.
So the PBC structure helps raise capital while keeping the mission.
The move to a public benefit corporation structure, or PBC, as MarketWatch explains, is intended to allow the company to pursue its mission-driven goals while also having the ability to attract the significant investment needed.
How does a PBC work again?
A PBC is a type of for-profit entity that also have a legally defined public benefit mission, essentially balancing the interests of shareholders with broader societal goals.
And the nonprofit stays in control.
The nonprofit entity will maintain control over the PBC and will be its large shareholder.
This follows some earlier controversy, right?
This decision follows earlier scrutiny and concerns raised by prominent figures in the AI field, like Geoffrey Hinton, regarding the potential risks associated with a purely for-profit structure, especially around safety.
Makes sense. Okay, across the Atlantic again. Portugal. Novo Banco.
Yes, Bloomberg reports that the Portuguese lender Novo Banco, which is majority owned by Lone Star, is aiming for a potential initial public offering, or IPO.
Possibly soon.
June.
Possibly as early as June. That would be a significant event for the Portuguese stock market.
How far along are they?
According to the Bloomberg article, Novo Banco's CEO has stated that the bank is well advanced in drafting the necessary IPO prospectus and is currently working closely with the Portuguese securities regulator.
So June or September are the windows.
They are eyeing potential launch windows in June and September of this year, with the ultimate timing being dependent on prevailing market conditions.
Would be the first major IPO there in a while.
If it proceeds as planned, this could represent Portugal's first major listing on its stock market in 4 years.
Novo Banco has been turning things around, haven't they?
Novo Banco has been working to strengthen its financial footing after its formation from the remnants of Banco Espírito Santo.
And Lone Star is selling a stake. Lone Star, the majority shareholder, reportedly intends to sell a stake of approximately 25% to 30% in the IPO.
Any sense of valuation?
Analysts at JB Capital have provided an estimated valuation range for Novo Banco of between $5.5 billion and $7 billion, so potentially significant.
Okay, staying with investment strategy, Warren Buffett.
Some timely wisdom after a volatile April.
MarketWatch shared his advice, which, as always, seems to be about staying calm and keeping a long-term perspective.
Indeed. Buffett's remarks, as highlighted in the MarketWatch article, strongly emphasize the importance of detaching emotions from investment decisions.
He said Berkshire makes its best deals when?
Famously stated that Berkshire Hathaway often makes its best deals when people are the most pessimistic.
He even mentioned missed opportunities.
He shared a humorous reflection on some investment opportunities he missed early in his career due to his own anxieties, while underscoring the fabulous opportunities that historically arise precisely because of such human behavior, fear, and panic in the markets.
And he downplayed the recent volatility,
characterizing it as really nothing when viewed within the context of historical market crashes and subsequent recoveries. His core message remains consistent.
Focus on value, long-term outlook.
Exactly. Rather than getting swayed by short-term market fluctuations.
And speaking of taking a broader view, there was a podcast featured on Bloomberg suggesting investors look beyond the U.S.
Yes, the Marin Talks Money podcast. Louis Vincent Gave made the case that investors may no longer need to focus so exclusively on the U.S. market for returns.
That's an interesting perspective, given the U.S. market's dominance for so long.
Gave's argument, as presented in the Bloomberg piece, centers on the idea that the traditional pillars of U.S. market dominance might be starting to erode.
Like the dollar status, Treasury appeal.
Points to factors such as a potential weakening of the U.S. dollar status as the global reserve currency, a potentially diminishing universal appeal of U.S. Treasury bonds as a safe haven asset.
U.S. growth slowing. Tech leadership challenged.
The possibility of a U.S. economic slowdown and the increasing dynamism and innovation happening in technology sectors outside of the U.S.
So where should investors look?
Consequently, he suggests that investors should be exploring opportunities in other regions, including Latin America and China.
What does he see in China?
Where he sees undervalued technology companies, government stimulus efforts, and a growing focus on dividend-paying stocks.
Any other areas? Commodities. Gold.
He also recommends considering commodities as well as select UK large-cap companies with exposure to those sectors, and even gold.
Gold, even though it's not cheap.
Which, despite not being cheap, he believes could benefit from a potential shift away from a purely dollar-centric global financial system.
Okay, finally, let's look at the tech sector earnings outlook again.
Right. MarketWatch reports that analysts at Melius Research are expressing relief over big tech's continued commitment to significant investments in AI development.
Good news for NVIDIA and Broadcom.
They see this as a key underlying factor supporting investment theses for companies like NVIDIA and Broadcom. Given the hype around AI, that continued investment is crucial.
The Melius research analysis underscores the critical importance of sustained capital expenditure in AI for these tech giants' long-term growth.
This is particularly relevant for a company like NVIDIA, which faces potential headwinds in the Chinese market due to recent U.S. restrictions on its advanced H20 chips.
Those restrictions could cost them billions,
Potentially over $15 billion in annualized revenue, yes.
but demand from hyperscalers could offset that.
However, the analysts anticipate that strong demand from hyperscale cloud computing providers and other enterprise clients will help to offset these losses.
NVIDIA is also waiting on that AI diffusion rule clarification.
Yes, which could have broader implications for the sector.
But overall, the outlook for NVIDIA looks okay.
Despite these uncertainties, Melius Research sees significant tailwinds for NVIDIA stemming from the increasing adoption of advanced AI models and inferencing technologies. They report a clear line of sight on substantial orders from hyperscalers through year-end.
How about Broadcom?
For Broadcom, the analysts anticipate less direct exposure to the AI diffusion regulations, and their software business is expected to be largely insulated from tariff-related impacts.
And Microsoft.
Microsoft is seen favorably, positioned to potentially lead the AI group again, and also less exposed to tariff risks.
Apple, Google, Meta still face challenges.
While companies like Apple, Google, and Meta may still face certain challenges related to ongoing tech court rulings and the broader tariff environment.
So to quickly recap the key headlines we've navigated in this deep dive,
Yeah,
it's been a lot.
definitely covered a lot of ground.
We examined the unfolding political situation in Germany, the significant and varied impacts of tariffs on major corporations like Ford and Mattel,
As well as the knock-on effects on the Chinese economy.
the growing expectations for further interest rate cuts from the Bank of England, Geofinance's debut bond offering in India,
The cautious perspective on the recent equity market rally from Goldman Sachs, the Hong Kong Monetary Authority's significant efforts to defend its currency peg,
Tehran's central bank's dollar purchases, the concerning trends in U.S. student loan delinquencies,
OpenAI's revised structural approach as a public benefit corporation, Novo Banco's potential IPO in Portugal,
Warren Buffett's timeless investment advice, the argument for investors to look beyond U.S. markets.
and the outlook for the tech earnings season amidst substantial AI investments and ongoing tariff concerns. It's a lot to digest.
It is, but understanding these interconnected global economic and financial trends is crucial for making informed decisions in the current environment.
Absolutely. Each of these headlines offers a piece of the puzzle, illustrating the complex forces shaping our financial world.
Well said. We'll see you all tomorrow morning with new headlines from major financial magazines.